Good morning, everyone. I'm Prachi, and I'm your host for today's webinar. I once again welcome you all on behalf of entire Pentagraph team to the PentaTalk series. The PentaTalk series has been a platform that brings together brilliant minds and thought leaders from various fields to share their expertise and insights. It is a testament to our collective commitment to growth and continuous learning. I'm delighted to have you all join us as we delve into the question, is recession a worry for India's growth path towards a 5 trillion economy? A thought-provoking webinar on a topic that has been the subject of intense debate and speculation in recent times. Today, we have gathered here to explore the various dimensions of this topic and gain insights from our esteemed speaker, Mr. Chandraprakash Gadiyar, sir, Senior Fund Manager, Equities at Tata Asset Management, who bring a wealth of knowledge and experience in the field of economics and finance. Please note that we will have a Q&A session towards end of this webinar. If you have any questions during the session, feel free to put your questions in Q&A tab on your Zoom screen, and we will be happy to take it during the Q&A. Before we dive into the session, I would like to take a moment to introduce our esteemed speaker of the day, Mr. Chandraprakash Gadiyar, sir, who will be sharing his valuable insights with us today. Mr. Chandraprakash Gadiyar is a Senior Fund Manager Equities at Tata Asset Management. Chandraprakash, sir, joined Tata Asset Management in September 2018, bringing with him a wealth of experience in the field of research and fund management. Prior to his role at Tata Asset Management, he served as a portfolio manager for the onshore long-only strategies at Alchemy Capital Management Private Limited. With over 21 years of experience in the industry, Chandraprakash sir has made significant contributions to the field of equity research and analysis. He began his career at UTI Mutual Fund, where he honed his skills and gradually rose to the position of fund manager, overseeing various mutual fund schemes. He holds an MBA in finance from Symbiosis Institute of Business Management, affiliated to the University of Pune. In addition, he has demonstrated his commitment to professional excellence by successfully clearing all 3 levels of the CFA from the CFA Institute, USA. His extensive knowledge and expertise in the financial realm makes him a valuable asset to his company. We look forward to hearing his valuable insight on the topic at hand. So without further ado, let us engage in this enlightening conversation and gain deeper insights into the question, is recession a worry for India's growth path towards a 5 trillion economy? I now invite Chandraprakash sir to share his thoughts and expertise on this crucial matter. Thank you all once again for joining us, and let's embark on this intellectual journey together. Over to you, sir.
Good morning, and thank you, Prachi ma'am. And let me first thank Pentagraph as an organization to invite me to kind of address the August gathering here. And good morning to all who've joined on the call. It's a very interesting topic, very, let's say, apt topic for today's times, because there is this, in fact, I would want to start by saying that we are in an interesting world where on the one hand, there are fears of recession or growth slowing down in most parts of the developed world, whether it is US, Europe, UK, China, Canada. And on the other hand, and I'll discuss more in detail. On the other hand, we have India, which kind of stands out in the overall scheme of things. And which is the topic of today, which is that when the world is slowing down, can India still achieve sustainable growth of, let's say, nominal GDP terms between 8 to 12% annually, which means that in let's say 5 years time or 7 years time, anywhere between 5 to 7 years time, can we be a $5 trillion economy? We are something like $3 trillion right now. So let me start the presentation by saying that there are two things that I follow, or let's say we at Tata Mutual Fund like to study regularly to come to a conclusion on how economy can or is behaving, and what can be the implications for from that perspective to all asset markets, especially equity as an asset class, because at Tata Mutual Fund we are among the top equity asset managers in the country, and that's our job to identify where we can make better returns for investors going ahead. So the two things that I said, let me start with the first thing. The first is banking sector. Now, in our experience, or in we have realized over the years is that banking sector plays a very important role in the functioning of an economy, because what basically banks do is they take deposits from the population in a country and channelize that deposit to give out loans to the needy, whether it is personal loans, housing loans, or corporate loans for investments. So if, and in economics, we call it as velocity of money, which is that if money creates money, then there is growth in the economy. Because and if you've noticed over the last since let's say the Second World War, or let's say Bretton Woods, and in the way currencies have evolved over many years now, uh, the we have seen that leverage in the economy is going higher. Sometimes it is household balance sheet which is taking loans. Sometimes it is corporate world that is taking loans, and sometimes, and most of the time, it is the government which is taking loans, meaning that their tax revenues, the government tax revenues, are lesser than what they spend annually. So there is this fiscal deficit that they need to fund every year. So they fund it through borrowings from the market, so which is borrowed through government securities. Now, banks play an important role in this whole ecosystem, in the sense that banks give out loans, and if money is freely available on an annualized basis, or let's say at the right price, right interest rate, if banks are willing to lend, and the willingness to lend comes from NPAs, which is that there are cyclical factors which determine whether banks are more than happy to lend or restricted to lend. For example, let's say in India is an example, or let's say world as an example, 2008 financial crisis that happened. Uh, Post that, there were fears that many businesses will not be able to sustain. And in that period, generally banks become very tight in lending. So when you become very tight in lending, money is not freely available. The right borrowers, if suppose a corporate wants to do capital investment in their business, or let's say you and me want to buy a house, we all do it on housing loan. If banks doesn't give loans, then there is an issue, because then the investment, if I can't buy a house, then the builder who is developing the loan, who is developing the house, will have stress in their balance sheet because the house is not being sold, which means that they in turn default, or the construction activity stops, so the economy stops. So banking plays a very important role, and hence it is very important from our perspective to look at banks. We've been consistently monitoring this. So just to put things in perspective, between 2000, let's say 2008 and 2020, in the US economy, and I'm referring to the developed market first, and I'll come to India later. In the US economy, banks have been doing reasonably well, though central bank in the world has been, across the world, especially US, have been focusing on increasing growth. So they have consistently raised or reduced interest rates. In fact, there were many years where interest rates were close to zero, or negative interest rates. But and in that environment, banks were doing reasonably well in the US. And there were, by the way, just to give you a perspective, there are more than 4,000 plus banks in the US economy. So it's a very large ecosystem of banks compared to India, where you have you can count on your fingers how many banks we have. In the US, there are more than 4,000 banks, and out of that, majority of them are so-called regional banks, and they kind of cater to one community or one part of the economy. They are niche in their segments. So just to put things in perspective, I'll come to the second point. Both are linked. Is that regional banks have been lending close to 50 to 60% of the overall commercial real estate lending is done by regional banks in the US. Which means that most of the commercial offices, malls, all those other places which are on rentals are provided, loans are provided by these regional banks. So they play a very important role other than other sectors where they lend to. Now coming to the original point, when money stops, then growth gets curtailed. For example, you would have heard in the recent past, in the last couple of, let's say last few months, last 6 months especially, when there were some banks, some regional banks, though they've grown in size, have either been forced to shut down or have been acquired by a large bank. And because of that, there is, and see, there is one big issue that has happened is that US Fed, after a long period of zero or low interest rates, started raising rates in the last couple of years. And so much so that rates have been raised to 5.25% from the US Fed perspective. And on the other hand, all of these banks in the regional banking space have not raised their deposit rates enough because they were not lending. What they were doing is the deposits that they were getting in their banks, they had deployed that amount in treasury bills or the government securities which the US government issued to borrow from the market. And those things, and because of that, there was this asset liability mismatch, that when your rates go up in the economy, you are unable to lend. On the other hand, your treasury bill prices goes down. So and because of that, they were not making money. And that is why they went down, or they were not, or their profitability suffered. And because of that, you are in a situation where regional banks are suffering, and there is a deposit outflow out of those banks, which means that people like you and me who are depositing money, opening savings account or a fixed deposits in those banks, did not feel the need to keep that money, because money market mutual funds in the US economy were paying 5% or 6%, whereas banks in the US were paying much lesser. So why would I keep my money there? So since banking sector issues started, banks are unable to lend. Now, when you can't lend money properly, or when growth in credit goes down, there are other factors as well. For example, in COVID times, US government spent a lot of money on giving stimulus, which is that they gave free checks to their population to spend. Because it was observed by the US government then that if we don't, and COVID times, everybody was sitting at home, work from home was there. So to stimulate the economy, the the government gave free checks. Same goes with Europe. You're in a different manner, but Europe also did the same. And their fiscal deficit went significantly higher in those years, almost like 11.5% to GDP. Which they have already brought down to something like 5-6% and needs to go down further. What it means is that the extra spending that they did between 2020 and 22, they are cutting down that extra spending to half already. And there is this US debt ceiling controversy that we are reading in newspapers every day. Basically, the opposition party in the US is saying that I will not allow you to raise more debt till the time you cut your spends. So US government obviously will have to cut their spends more. So on the one hand, banks are unable to give more credit because of their own issues. On the other hand, government is also not able to spend more money because they already spent in the past, and their borrowings have increased to a $31.5 trillion approximately. That's the US debt ceiling. It will certainly be increased. At least that's what has happened in the last 100 years at 80 times. So it is a consistent process. They will increase it further, but there always is this friction between the two opposition parties, or between the government and the opposition party, to restrict on spending. So let's see what happens. But the bottom line is that governments in across the world, especially the developed world, have overspent in COVID times. They are now reducing their spends, which means that when you spend lesser, it does impact economic growth, because some businesses would have benefited because of extra spends in COVID times. Now that spend is not happening. So that is one part. The second is US banking sector, because of their own asset liability mismatch, deposit outflow, are unable to create money. Velocity of money is going lower. On the third side, US Fed wants inflation to come down. So they have been pushing rates higher, and in fact have been very vocal, saying that I want inflation or unemployment rate to double. So if the unemployment rate today is 3.2%, they want it to go towards something like 5%. So they want job losses to happen in the economy. So clearly, you see most developed economies are slowing, will probably slow further. The other point that I want to add, the second point about global growth, is real estate. Between 2008 and 2020, across the world, let's talk about US first, real estate prices were booming. So in the US, for example, a typical house price on an average in the economy would have gone up by 3 times in 10 years plus. So it was a very, very significantly high bull market, and a large part of this price rise in real estate in the US economy happened in the last 3 years, or during COVID times and post that. And typically and it was a sign for the US Federal Bank to start raising rates, and one of the reasons for inflation was higher real estate prices, or high rental prices on that count. And we are now seeing, because of the high interest rates environment, and the federal bank and government not able to spend, there is this sentiment impact. Job losses have just about started in the economy. Unemployment rate will go up gradually over a period of time. And hence real estate prices have started correcting. So last 12 months, average US home prices have already corrected between 5 to 8%, if you, depending on which region you go in or which state you go in the US economy. Similar things are happening in Europe, in UK, in Canada, and in China. China, though it started 2 years back. Now, so the original point that I want to start, where I started with, the two things that we follow, one is banking sector and the other is real estate. Both provide or drive sentiment, drive wealth effect, and are a major factor to track whether the economy is going to do well or not. In that count, what I explained, I believe that growth slowdown is just about started. And in my opinion, or in our opinion, growth will probably remain weak for the foreseeable future. It will not be slow only for the next 3-6 months, as some people seem to suggest. We believe it may prolong for a longer period of time. There are some economists who have started saying it is likely to be deep recession. There are some economists who suggest it will be a mild recession, but recession it will be. And how does India fare in that environment? Let's come to that point, which is more important topic for us, because it impacts you and me. Well, for that, you must look at our history. Between 2008 and 2020, the same period, when banks in the US, Europe, China, Canada, all those economies were doing very reasonably well, our banks were not doing well at that time. If you go back to that period in India, 2000, after 2008, in fact, right up to between 2008 and 2013, the government of the day, the UPA2 government, was cajoling or asking banks to start reflecting on their books, and if there are any NPAs, then they should start providing for those NPAs. NPAs meaning the loans default that corporates have taken from them. And it is only in 2013 when currency depreciated very sharply. I think it went from 46 to a dollar to 68 in 1 year. And that was a period when the finance minister changed, if you all go back to our history. And Mr. P. Chidambaram became the finance minister, and he brought in Mr. Raghuram Rajan as the RBI governor in 2013. And they started a focus on improving the banking sector. And unfortunately, UPA 2 could not continue that job. So NDA government came in, led by Mr. Prime Minister, Mr. Narendra Modi. And it's the second tenure that he's been continuing with. But a good job that they did was they continued on their path to clean bank balance sheets. In 2014, that process started, and 2018-19 is when the process accentuated, or in fact, a lot of cleanup happened in 2018-19, and so much so that today, Indian banking sector balance sheets are the best ever. For example, the largest bank in the country, which is State Bank of India, in the last, and it has more than 100-year history in the country. The highest ever provisioning coverage ratio for the bad loans that they had in their balance sheet in the past used to be something like 65-68%. Today it is close to 85%. So the kind of provisioning that they've made for past NPAs or bad loans is highest ever for the overall banking sector. And because of that, so it, first of all, between 2008 and 2020, Indian banking sector was not doing so well. So the average credit growth or average loan growth for Indian banks was single digits, because they were not very happy lending, because they already had issues in their own balance sheet. Only private sector banks were growing fast because they did not have enough or high NPAs. PSUs were suffering, and government of India gave a lot of capital. More than 2 lakh crore worth of capital was given to the balance sheets of Indian banks. Too many things. So many things have happened in between. 2016, if you all, there were many things also implemented by the government. For example, first of all, there was demonetization, but after that there was GST implementation. Then you had IBC, which is Insolvency and Bankruptcy Code, which was implemented in India. That was a major reform, I would say, or we believe that's the best thing that could have happened for Indian economy, because post IBC implementation, Indian entrepreneurs also realize that they cannot borrow heavily and default on their loans. So things have improved significantly. The discipline with which entrepreneurs today borrow from banks is materially different pre-2016 and post-2016. And that has wide and large implications for how Indian banking sector will perform, or how cycles will behave over a period of time in Indian banking sector from an NPA perspective, and how sustainably our Indian economic growth can be for a long period of time. But coming to the original point, today banks have started lending at a faster pace. So today average credit growth for Indian banks have started growing at 15% plus. Last 1 year, which is FY23, the year that we've just closed, average credit growth for most banks is around 18 to 20%. And we believe that it is just the beginning of the cycle. We had a very long winter in that sense. From an economic perspective, banks were not willing to lend, so money supply was tight, velocity of money was low, and hence economic growth was not very high. I think we have begun a new journey, and it's just about started. So at a time when globally, and I'm again coming to the same point, 2008 to 2020, when global world or global banks were doing reasonably well, Indian banks were not doing well, and money supply was tight. So we are reverse of what happened globally actually. On the second point, real estate. In 2016, I think, or around that time, real estate regulatory authority was implemented to discipline the real estate sector. And because of that, for the first 3-4 years, real estate suffered significantly. In fact, I remember in 2018-19 or between 18 to 20 pre-COVID, Bombay city alone, or let's say Bombay and NCR, which is Delhi and Gurgaon and Bombay, these three places, which is a large part of real estate in India, there will be close to 100 plus developers behind bars because of defaulting on their loans. So it was a combination of IBC, RERA, GST, which made those changes. But the point that I want to make is that between 2008 and 2020, real estate prices in India were stagnant. They did not go anywhere. In fact, in that 12-13 year period, most developers were not launching new projects. Why? Because ready inventory, which is ready built houses, let's say in 2017-18, I remember the number across India, ready inventory was as good as 5 years plus, which means that if you don't build any new house, you are good to sell for the next 5 years. So the ready inventory in the country was extremely high. Investor community went out of the market in real estate. Nobody wanted to buy just to make money. Genuine home buyers were only probably buying houses, and hence real estate prices did not move an inch, barring a few local regions here and there, for a back-to-back period of 13, 14, 15 years actually. So in a time, again comparing the same thing, between 2008 and 2020, when the world saw real estate market booming in their economies, in our economy, nothing happened. We were kind of in a range-bound zone, so to say. And it is only now, and it is just about started last 2 years back, where real estate has started doing well. Real estate prices, in fact, if you would observe in your own location, wherever you are, in Bombay, for example, the place where I stay, residential real estate prices have moved up by 20% in the last 1 year. In Delhi, Gurgaon, I remember the largest real estate company in India, by the way, it's a listed name, launched a $1 billion project in the month of February or March of this year. And within 1 week, they sold a full $1 billion project. So those days have come again, where people are queuing up, and it's a 7 crore, 8 crore per house ticket size. So people are queuing up to buy flats and wanting to pay a premium to the builder to sell it to them. So the activity or momentum in real estate has just about started. Residential prices have started increasing. And in our opinion, the reason why it is happening, first of all, if you remember, I said that 17-18 average ready built inventory was 5 years plus. That same number today has come down to 12 months. It is hand to mouth. So because of that, when you don't have excess inventory to sell, developers have room to raise prices, and people are okay to pay higher prices. On the other hand, you have a lot of new development projects which are being launched. In fact, all the builders that we meet nowadays, there is a very large pipeline of projects which they are either planning or in the approval stage, and in the next 2-3 years, they'll launch them. So construction activity is likely to be very, very strong in the next 2-3 years. Because when you launch the project, you construct it, you sell it, and the momentum is good. So comparing the world economies with India now again, and I'll keep referring to these same periods, 2008 to 2020, and now you had money supply, easy money supply in the world between 2008 and 2020, and real estate booming, whereas now in the developed world, easy money supply is not there. Money supply is very tight. On the other hand, you also have real estate, which is tighter, real estate prices going down, which basically means that sentiment, wealth effect is lower. US Fed wanting to increase unemployment, which means that job losses will probably increase, which means that it basically means that growth will be slow in the world. On the other hand, all the reverse things are happening in India, which is that our banking sector is growing or likely to continue to grow for some time. You have real estate, which is booming. or doing reasonably well and likely to do well. Construction activity will pick up materially going forward, which means that India will do very well. There is a third angle to it, which I want to add to now, which normally we don't look at, but this time around India has this specific advantage, and hence it makes sense to tell you this. Uh, in my 23 years being in the economy or tracking or doing research on businesses and economy, this is the first time that we are seeing this phenomenon coming to India, which is manufacturing to India. The way global cost or let's say the way, first of all, geopolitics is playing out, where China seems to be flexing its muscles. They have become a large economy, and they seem to be flexing their power now. Because of that, most customers in the world for China, and China is the manufacturing hub for the world, with a $4 trillion worth of annual exports out of their economy. So it's a very large manufacturing hub for the world. In that sense, most customers of the world, especially the US and even European companies that we meet nowadays, want to outsource incrementally, gradually shift manufacturing from China to India or other countries. By the way, cost of labor for Indian businesses relative to China is 1/3. The recent BCG report that came out, in that cost perspective, we are 1/3 of China. So cost wise, Indian businesses are very competitive today. And you also have this geopolitics which is playing in. And at the same time, government of India, and rightly so, is pushing manufacturing in India, both for Indian consumption and trying to make India as an export hub. So there are sector by sector, in fact, production linked incentive scheme itself, where government is giving $35 billion of incentive to Indian companies or multinational companies who want to set up capacity in India. They are giving out $35 billion over the next 3 to 5 years as incentive to make in India, and either for Indian consumption or for exports, for different sectors. And there are 15 sectors in that PLI scheme alone. Apart from that, what government of India has done is they have identified sector after sector where Indian businesses or Indian entrepreneurs have created capacity in India. And in spite of that, we were importing from China. So what they have done is they have either put anti-dumping duty on Chinese imports, or they have increased the size of global tenders for by Indian PSUs, public sector undertakings. In the process, there is this distinct advantage for Indian companies. Anyways, cost structure wise, we were good. Chinese government was giving subsidies to those businesses to sell to India or other countries. And that Indian government has done a great job in identifying and giving business to Indian entrepreneurs. So what we are seeing today is manufacturing. There is a very large revival of manufacturing in India. What does it mean? It means two things. One is the Indian companies are in a capex mode. Almost every company is expanding their capacity, businesses are becoming more scalable. When you scale, your cost reduces even further. So you become even more competitive relative to a country like China. So your scalability is happening, and most companies are in a capex mode. We can see it happening. It just started. In our opinion, this will go on for the next 5-10 years, if not longer. And we think in many places, in many sectors like auto ancillary, value-added steel products, light engineering, chemicals, pharmaceuticals, we are already competitive relative to the world, and we are gaining market share both for exports and for domestic consumption. And that is something that we have not seen for a long time. At least in my 22, 23 years careers of doing research, we used to always see that imports were happening more and more, and domestic investment was lagging. I believe we are in a very good time where capex will increase significantly. What we also believe is that when capex happens, a lot of new job creation happens. So demand for labor is increasing significantly already. And in the next 3 years, 3 to 4 years, the visibility that we have from the pipeline of capex that is happening, we believe PLI alone will add something like 4 to 5 million new jobs, 40 to 50 lakh new jobs on an annual basis. or on a cumulative basis on a 3 to 4 year period. And other than PLI, the other businesses which are expanding will also add significant jobs. In fact, in our interaction with staffing companies who provide staffing solutions to manufacturing companies, they have very large pipeline of recruitment to be done in the next 3-4 years. So all in all, I think on the one hand, you have cyclical factors, which is banking, real estate likely to do well, which mean that economy anyways will be doing reasonably well. There is this wealth effect. On the other hand, you also have an additional factor this time around in this cycle of manufacturing, of capex, of new job creation, which mean that economy is likely to do reasonably well. So to conclude, my thought is, or I think over the next 3-5 years, when the world is slow, India is likely to stand out. It may not be a very high growth. See, in between 2004 and 2008, which was the previous bull market, when the world was doing well, Indian economy grew at 8% real terms, and you add inflation, so we were growing close to 13, 14, 15% nominal GDP growth. Today, when the world is going to be slow, and we are going to stand out, doesn't mean that we will grow at 14, 15% on nominal terms. We will grow, but we will grow anywhere between 8 to 10% nominal growth. And that is what I started my talk with, is it possible to grow at 8 to 10% on a nominal basis, on an annual basis, if growth in world is slowing, or if recessionary circumstances are there in the world? I would say a big yes. Every indicator that we see points us to or suggests to us that growth will be more stable, more sustainable, and India will stand out in the overall scheme of things. What does it mean for equity markets? It basically means that corporate profit growth, because if nominal GDP growth is likely to grow at 8 to 10%, profit growth is generally a multiple of nominal GDP growth, something like 1.2 to 1.5% multiple, which means that if you, let's say, do 1.2 on a conservative basis, your profits can still grow at around 12% every year. Just to put things in perspective, between 2008 and 2020, when Indian economy was not doing so well, average corporate profit growth was something like 3 to 5% CAGR annualized. So our businesses were not growing so fast. Today, when economy is starting to do well, our average corporate profit growth is already 15% plus, and looks logical to assume that this run rate, or slightly lower, around, to become the conservative side, around 12% CAGR is possible. And when profits grow, equity markets do well, because valuation of a business is a function of how profits and cash flow grows. So as they say, equity is a slave of earnings. So if earning grows, equity market does well. So I would say that if you take a longer term view, which is 5, 7, 10-year view, we are probably lucky to be in this economy, in this market, in this time, and hence good time to invest for the long term. So with this, I will stop, and we can, if you have any thoughts, any questions, we can take that. Thank you.
Thank you, sir, for delivering an incredibly informative session that has broadened our horizons and left us inspired. Ladies and gentlemen, as we near the end of this captivating online session, we are now opening the floor for the questions. We kindly request you to either type your questions in the chat box under the Q&A tab, or raise your hand virtually. We'll just wait for a minute or so to check if we have any questions. So we have our first question from the audience. It's, private banks are better or PSU are better to hold for long term?
Well, since you ask in your question, there is this long term that you have mentioned, and hence the answer is very obvious. Long-term private banks are much better than PSU. The reason is that PSUs tend to have social obligations also along with business obligations. Uh, for example, Jandan accounts. Most PSU banks are not making money out of creating those Jandan accounts. So there are, or let's say, there is this, there was this scheme of Government of India, long time scheme, where they have to give small ticket size loans to individuals, which is called Mudra scheme. There were times when Mudra schemes gave a lot of NPAs or they were not good loans to give out. So in that sense, the return on equity profile of PSUs generally tend to be on the lower side relative to private banks. And private banks are able to grow faster because of their size also, faster than PSU banks. So valuation, there is a valuation difference. So on a long-term basis, I would say private is more preferred. Having said this, given that all banks today are likely to do well, whether it is PSU or private, small, mid, large, any bank, and where valuations are reasonable, my observation would be, or my view would be, that in the immediate term, which is the next, let's say, 2 to 3 years, it is possible that both private and PSU will do well, because there is valuation room for valuation re-rating is there even in PSUs today. They are quite reasonably valued. Though you have to choose your bank well, you cannot buy any and every bank and expect to do well. Do your due diligence in terms of identifying the right PSU and right private bank. Even in private, there is an issue in some banks, so you have to choose them well. So maybe the answer is that in a short to medium, which is 2 to 3 years, let's say between now and 3 years, all PSU and private can do reasonably well. Long term, private.
Thank you, sir. We have one of the advisors who wants to ask question.
Hi, Chandraprakash. Good morning.
Good morning.
Chandraprakash, I've been, since your alchemy days, and it's been really nice to, have you on the call here. So, just to continue with the banking question. So, banking always has been, I think, 20+% more on the Nifty weightage also, always, right, throughout. So, but so are we in the cycle wherein, because as you said that, the balance sheets are clean, we will now have a growth phase, and then again when the bad debt starts going up, then that time is wherein you have to be cautious. What is the difference? So it's just because of the balance sheet being clean, or so that is one. And the second thing on PSU, as you said, the social obligation, that I think has been reduced, right? So earlier this thing was, you have to lend at a gunpoint kind of a thing. I think even that effect is now no longer that much, if I'm not wrong. So your thoughts on both?
Sure. So first on the social obligations, the question is about long term, and hence I said that long term nobody knows. Today,
Okay.
the political equations, I would agree, the current, from what we understand, the current political ecosystem is helping PSU banks to also do very well. So I would say that as of now, which is why I said that the next 1 to 3 years doesn't look bad actually. But if I take a longer term view, I don't know. Things can change, political equations change, and hence it is better to stick with private banks where it is, we know that things can continue to do well. So that's on the social or PSU bank question. The first part of your question, Pushkarji, was what?
So basically, yeah, the balance is being clean right now. So it will probably take next cycle wherein we have to be cautious. So basically, to put it correctly, do you mean that instead of being into a Nifty or a diversified this thing, we can have a banking sector allocation as a thing also, if that is so much of heavyweights, which you also are saying that banking makes more sense. So is it something like that wherein we can take a sectoral call on banking?
Sure. So on this, I would say that it is not only because current books are clean, but when we meet banks today, there is, in fact, when we look at SMA 0, 1, 2 data, which is 30-day, 0-day, 30-day, 60-day past due, 90-day past due, it is at an all-time low, which means that even the incremental loans that are being given right now, or last 1 year loans, 2 year loan, 3 years loans, the default levels incrementally are at an all-time low. There is no sign of yet as of now. And we are still watching this space. It is a daily exercise, weekly, monthly, regular exercise that we do. It's too good to be true, actually. Sometimes we believe that this can't be the real number that most banks are reporting today. But the environment is such, it is that people are not choosing not to default, actually, and be very disciplined in their approach, even in unsecured personal loans. So I would say that growth is happening. NPAs, incremental NPAs, at least the next 6 months. See, always you have a visibility of 6 months, and 1 year also you have a fairly good idea. So for the next 12 months, I'm pretty sure in telling you that NPA situation for banks is likely to be at an all-time low only. There is no sign of that picking up, which means that if growth is coming, then profit growth will be very healthy, and return on equity profile will remain at a stronger pace, and the last point is that valuations are still reasonable. It has still not moved to a level where I start saying that now it is fully valued. There is room for re-rating in most banks. Some of them are on a reasonable price already, but most banks, there is room for re-rating. On your second part of your question, does it mean that we look at banking sector fund or a thematic fund, which is purely banking sector dedicated fund? You may, but I personally see thematic funds or banking sectoral funds are primarily for people who know when to enter and when to exit.
Correct.
I personally, if you know this, or if you can time your entry and exit very well, then I would advise, yes, please go ahead, because at least the next 1 year certainly looks very good. 2-3 years also looks reasonably good. But ideally, I would always advise to do a flexi cap or a multi cap or a large and mid cap or a diversified fund. That even there you would find banking sector allocation to be anywhere between 25 to 5%. So it's a fairly large allocation. So you can benefit, and you also have the advantage of choosing the right bank, because the fund manager is doing a good job for you for identifying which banks will do well. Whereas in a banking sector fund, you will have all banks. So if some of them are not doing well, you will get averages also. So it depends on your choice. If you want to take more risk, yes, a pure banking sector fund does make tremendous sense. And if you can time your entry and exit, even better. So that would be my answer.
Okay, thank you, Chandra.
Pleasure.
Thanks, Pushkar. Thank you, sir. We have a couple of questions with us. I'll just read it out for you, sir. There are a couple of them which I'll just merge together. Everyone talks about India's growth story in coming years, but what are the hurdles or negatives that you expect which may hamper this growth story, or any other negative points that recession which will stall this growth story?
So one thing that we all have to keep in mind when we talk about risk is crude price. We are a net importer of crude. In fact, 70% plus of crude that we use is imported. We are, as we all know, as of now at least, we are a large trade deficit economy because of crude largely, but we also import many other things, which is stopping now. So trade deficit on a manufacturing side will hopefully change as and when manufacturing picks up. But crude is a major factor. If crude prices were to sharply move higher, it can impact our macro factors, including forex reserves, including interest rates outlook, including currency outlook, including growth as well. So crude matters to us, energy price matters to us. So if I have to pinpoint one risk factor for Indian economy or Indian equity markets, crude is the risk factor. As of now, crude prices are reasonable at around $75 to a barrel. Up to $100 is very manageable for us, given the size of the economy, how we have grown and how our trade deficit is improving. Maybe up to 120 we can manage because of the way our manufacturing exports are picking up now and our imports is reducing. For example, I don't know whether you've seen in the newspaper recently, last year, FY23, India exported 7% of Apple iPhones out of India. And the number is important because till 2019 calendar year, we had zero manufacturing of iPhones in India and we used to import 100% of it. So today we not only not import, but we are 7% of global iPhone manufacturing, Apple iPhone manufacturing. And Apple CEO Tim Cook was here in India recently, and he said that by 2025, so in the next 2.5 years, he wants India to be 25% of global iPhone manufacturing. So that's the scale with which manufacturing is shifting. It's a good example to give to tell you how fast manufacturing is shifting to India in some segments. Yes, we are still kind of, we don't yet manufacture all components for the Apple iPhone, but at least it's a good beginning. And over a period of time, we'll start manufacturing components as well in a larger manner. So trade deficit is also improving. So hopefully by 5 years from now, the concern of crude will also go away. But for the time being, I think crude is the biggest risk. Then there are other smaller risks like monsoon. The Met Department is suggesting that there could be an El Nino this year. So short term, if monsoon is not very good, we can get impacted. Or in general election in 2024 May, if the current government does not get extension of their one more term, or they do not win election, then there could be some knee-jerk reaction in the market. So those things are short-term issues, but longer term, it is the crude price.
Thank you, sir. There's one more from Mr. Sandeep. In terms of growth, which segment will grow more, large, mid, or small cap?
So I would say when economy does well, all parts of the market do well because they are a function of the economy. And generally, I would say that all segments of the economy will do well, whether it is large cap, mid cap, small cap. Growth will be pretty decent everywhere. Having said this, one question that you did not ask, but I think I can highlight, is that if manufacturing ecosystem sustains the way or our entrepreneurs execute it as well as what we expect them to, and since manufacturing is largely in the small cap space, the near term or the immediate 3-5 year outlook for growth relatively is probably highest in small caps. And it is a big if also though, an execution risk always remains because it is not a given that manufacturing will shift from China to India. You have to execute it well at the right price, right cost, and you have to build your facilities at the right time. So given all of those disclaimers, I would still say that my bet is that manufacturing will do very well or our companies will do very well on manufacturing, both for domestic requirements and exports. And hence my personal opinion is that small caps have a larger room to grow or faster pace to grow. Having said this, large cap and mid cap will also grow. So growth will be quite balanced everywhere. Maybe small caps relatively will grow faster.
So Mr. Subibala wants to ask you, how would social tensions caused by widening inequality in society be leveled? More welfare spending, or we will have to live with it?
So this is a very, very important question or topic which unfortunately inequality has grown across the world, and the only way to solve inequality is growth. As and when economies grow sustainably over long periods of time, it channels down to the lowest level of the strata. So I do hope that businesses in India will grow at a fast pace, and that's my view as well. I think in the next 3, 5, 7 years, or maybe longer, Indian economy will grow at 8 to 10% on a nominal basis. Though I am not an economist, so I'm giving you a range. I don't know the exact number, uh, but I think we will grow at a fast pace as an economy. And as and when economy grows faster, I think everybody will benefit. Our standard of living across the population will improve. Some more, some less, but everybody will certainly for sure improve. Salary levels will go up. Whoever is earning, their businesses will do reasonably well, which means that I'm hoping some amount of inequality will go away because of a sheer growth in the economy, and some amount of welfare spending that the government does will continue to do. So it's both actually. It is not either or. You also have to do welfare spending to the deserving, and you also have to enhance our growth stature and sustainability of growth. My view is that the next 5-10 years we will probably have both, and that I'm optimistic. I think some amount of inequity will surely go away.
Miss Akshata Patel says, thank you, sir, for wonderful insights. As you mentioned about US and Europe economy recession, what are the predictions about IT sector, which is dependent on these markets?
So on IT, thank you for the question. Given my view on growth being slow, or our view in Tata Mutual Fund, we also believe that growth will be slow. At least in the next 1-2 years, there are headwinds for the IT sector companies to grow at a fast pace. So for example, between COVID years and now, average profit growth for IT sector companies was between 15 to 25% consistently for 3-4 years. And generally what happens is that when a overall sector starts growing at 15 to 25% year after year, expectations of higher growth for future grows, or people start expecting that this sector will keep growing at this pace. And hence valuations for the IT sector had moved significantly higher in those years. Whereas today, when expectations are coming down for the sector companies, for example, FY24, the top 2-3 companies in the sector have guided the market to grow at anywhere between 4 to 8% on profit terms, which means that growth is far slower than what it used to be in the previous 3-4 years. And hence valuations are moving down right now, as you notice. Having said this, what is also happening interestingly is that most of these companies are generating so much cash on an annual basis now and they have kind of committed to pay 80 to 90% or sometimes 100% of annual cash as dividend to investors, either buyback and dividend or only dividend, that the dividend yields of IT sector companies have moved or are between 3 to 5% already on an annual basis. And if this trend continues, then in a couple of years, most of these companies, if stock prices remains where it is, will move beyond 5% also, which means that there is this, in my opinion, there will be a floor to stock prices. It stops falling because of a high dividend yield that these companies are able to generate. From a shareholder return perspective, dividend yield matters. So my opinion is that maybe downside is not significant from current levels. But given the growth is slow, maybe you will not see high returns at least in the next 12 months. But you may not expect, or you should not expect, that's my view, you should not expect any material downside from current levels. So it's a range bound environment for this sector right now from a stock market perspective. As and when global economy stabilizes and start doing well, one can look at the IT sector in a favorable manner. For now, it's more a range-bound scenario.
Thank you, sir. We have Mr. Vikrant asking, how do you see effect of AI on our economy?
So it's evolving. For example, Microsoft, when you look at that company, and it's a listed company in the US, so when you follow them, almost every week something new is happening. And generative AI, we all know of ChatGPT 1, 2 versions, and I think it can potentially have very wide implications for a lot of businesses, a lot of governments, a lot of economies. But we'll have to wait and see. Early days, all I can say is for sure is that it will certainly have an impact. Productivity, for example, and any economy can sustainably grow only by improvement of productivity. And to that extent, AI has the capacity to improve productivity by multiples. So I am optimistic, actually. I think about it from a positive side of equation. There will be some job losses for sure for people who are impacted by AI. But there will be the other side of the equation is that productivity in the economy will grow materially high. So if you are on the positive side of it, you will benefit as well. So equity investors can take advantage of that trend. So there are both positives and negatives. I am more on the positive side, but early days, we'll have to wait and see.
Okay. We have Mr. Prashant, who says there are a few Indian startups which are getting funding from US or other countries. Do you think there will there be any impact, either positive or negative, funding based on banking situation in their countries, specifically US?
No. So don't link it with banking. My thought is that, so what has happened in funding is that when money supply was very easy in the US economy, a lot of private equity funds raised a lot of capital. There were these SPACs also in between, special situation vehicles in the US, which were listed vehicles to acquire companies, for example. So it happened in free money kind of environment where interest rates were zero or negative. In that environment, naturally, what happens is that when too much money is chasing too few businesses, valuations go beyond normal levels. So valuations were crazy, in my opinion. On hindsight, we can obviously say that. And since valuations were very high, and people were willing to give high valuation to companies where there was no visibility of making profits. On losses also, valuations were very high. So that has changed today. Because interest rates have moved higher, there is no free money available, liquidity is tighter, economies are slowing. So private equity, the free money that private equity money was or funds were getting is on the lower side. In fact, no new funds are being launched now incrementally, or very few funds are being launched on private equity side. So there has been a large amount of valuation derating that has happened on the unlisted side, on startup ecosystem. And in the process, most of those businesses which did not have a profit path to profit over the immediate term, next 3-4 years, those companies are suffering, shutting down, closing down, M&A is happening. So that is a normal process that we are going through. It's just that when expectations go very high, it's like IT sector, the answer that I gave. When things were very good, expectations were high, so valuations went high. Today, when things are weak, expectations are coming down, so valuations are coming down. So it's a normal cyclical factor. I don't think you should link it with banking sector.
Mr. Nitin Mule has a question for you. Do you think any potential change in central government in terms of whose ruling party will have impact on some of these projections?
So, Nitin, I would say that early days to react to this question, because in elections, I have learned one thing is that the last 1 month pre-election is what matters. whatever hard work you do or whatever good work you've done till in the last 5 years can all change in the last 1 month. So we need to wait. I don't think. But having said this, your question was if something changes, will it impact? As I said in my opening remarks, surely yes. If this government doesn't get re-elected, there will be a knee-jerk reaction, negative knee-jerk reaction in the markets for sure. But it will be a short-term impact because businesses continue. For example, I remember during Mr. Vajpayee tenure as the Prime Minister, the previous NDA time, when he lost the election, when that India Shining ads were all around the country, there was this knee-jerk reaction, negative by the market there. But ultimately, when UPA 1 came, things normalized and business came to normal and stock market went on their own. So ultimately, earning growth is what matters. But yes, short-term impact certainly will happen.
So Mr. Meksham Sinkar wants to ask, what is your view on de-dollarization, which is being highly discussed about of lately?
So it's I think, as always, there are countries which are trying to diversify their dollar reserves to other currencies. There is a lot of political equations changing that we can see today. For example, I was very surprised to see, or very positively surprised to see, with the way Middle East, Saudi equations are changing with Syria, and now it's interesting times actually with China trying to work with Russia, Middle East in a bigger manner. So, yes, there are a lot of political activity going on. Having said this, see, the reality is that US is the largest consumer in the world. So US buys most of what the world produces every month, every year. When they buy, they give you dollars. They buy in dollars. So they give you dollar as a currency. When you as a country get dollar as a currency, most of it will remain in dollars because you have to trade with US. So till the time they are the largest consumer in the world and they run a very large trade deficit, they don't make themselves many things. They are the largest consumer of last resort actually for the world, including China. Very difficult to assume that anything material can change till the time this equation remains. And in any ways, currencies or the way, or let's say reserve currency, these things take a lot of time. It's a beginning. People are trying to find answers. Who is the alternative currency and what can change? But till the time, I would say that till the time US is the largest consumer, very difficult to change.
Pushkar wants to ask if it will have any impact on gold.
So gold is a hedge for bad times, as we all know. Today, when interest rate outlook is moving higher, so it's just that when interest rates were zero or close to negative and governments were running high deficits, people or most economists in the world were suggesting to buy gold as an hedge because the question was that governments and central banks were not behaving themselves. Now, when government deficits are likely to move down, at least they are talking of it, and US Fed and other central banks are increasing interest rates or have already increased interest rates or normalized now, the outlook on gold as a hedge is not so great today. Having said this, the other part of the question, the previous question on US dollar reserve currency, you must notice that one of the things that central banks in the world are doing is that instead of keeping everything in dollar, most central banks have been buying gold also. So the reason why in a high interest rate environment, gold has still behaved reasonably well is because most central banks in the world have been buying a lot of gold to keep in their reserves. Otherwise, the correlation is such that when interest rates go higher, gold goes down. This is one of those years where that correlation is not working because central banks are buying. to conclude, I would say that gold is a good hedge if something negative on currencies or on fiscal deficits or on government defaulting happens. For now, things are stable, at least in the next immediate term. I would say that there is no fear of a major crisis.
So we will have one last question for today, sir. There are quite a lot, I think, but due to time constraint, it's difficult to address them all. Mr. Vikrant Kodgirwar wants to ask your opinion on pharma sector.
So thank you for this last question, Vikrantji. On the pharma sector, I would break it up into two parts. One is the and where US is a large part of profit pool for most Indian companies in pharma sector. There is a lot of pricing pressure in the US market. And I would say that it is continuing even now. So I don't see, at least in the near term, which is the next 6 to 12 months, earnings outlook for branded generics or generic pharma exports out of US or let's say from a stock price perspective for the pharma sector. I think it will be more range bound. Valuations are reasonable for most of the pharma companies, but earnings outlook is not so great in the near term. On the other hand, the second part of pharma sector, which is pharma manufacturing, which is CDMO, contract development, manufacturing, research, that piece is likely to do very well. And there, I think Indian companies have some advantage to gain market share gradually, though. But there is room for, and now after COVID, CDMO was slow. Now I see CDMO picking up also because global pharma companies have started traveling to India again. So it took a lot of time post-COVID, but now things have stabilized. So my sense is that the next 3-4 years for manufacturing, contract manufacturing and research for pharmaceutical, global pharma can do very well. So my bet is on that piece, whereas on the normal pharmaceutical business, both India government is pushing companies to reduce prices. There is pricing pressure in India and US. So these are two large profit pool for this sector, where there is some impact on earnings. So that's the answer.
Thank you, sir, for patiently answering all the questions of the participants. On behalf of Pentagraph, we express our heartfelt gratitude to all the participants and our esteemed speaker, Mr. Chandraprakash Gadiyar, sir. Your presence has made this session truly special, and we hope the knowledge gained here will continue to inspire and drive us towards new horizons. Thank you once again, and we look forward to meeting you all in the next month's PentaTalk series again. Wishing you all continued success and fulfillment in your personal and professional journeys. Goodbye, take care, and have a great weekend ahead. Thank you.
Thank you.
Would like to share an important disclaimer before we end the meeting. Mutual fund investments are subject to market risk. Please read all scheme-related documents carefully before investing. Thank you very much. Thank you, sir.
Thank you.